Mortgage interest rates hit 8% and then saw the third biggest improvement in well over a decade, dropping under 7.5%. Does this mean interest rates will continue to fall? Are they going to creep back over 8%? And more importantly, what does this mean for you? I'm Rebekah Daniels, your Sumner Insider, covering everything you need to know about living in Seattle, Tacoma, and everything in between. I am a firm believer that knowledge is power. And with the right knowledge, you can make the best decisions for you and your family. So let's get into it. There is a lot of uncertainty in the news about the state of our economy and the impact it's going to have on mortgage rates and home values. Mortgage rates are affected by a few factors. On a personal level, so these are your controllables. Your credit score. A higher credit score means a better opportunity for a lower interest rate. A lower score means fewer opportunities. Your debt to income ratio. Less debt is always good. And personal lifestyle choices. So are you a first-time home buyer? Are you a veteran or active duty? Do you have a lower income and you're looking in a rural area? Are you purchasing a multi-million-dollar home and need a jumbo loan? All of these things qualify you for different types of loans with different interest rate opportunities that may be a little bit above what you see in the news or a little bit below. So keep that in mind as you see and hear all these different headlines across the news. Now, let's talk about the uncontrollable factors, namely the Fed. The Federal Reserve does not directly set the rates for mortgages, but it does set the federal funds rate. You may remember a couple years back, in March of 2020, the Fed slashed rates to practically zero. The number one question I got that week was, does this mean mortgage rates are zero and should I buy a house right now? Now, unfortunately, it was not mortgage rates that were zero, but rather the cost, or the fee, if you will, at which banks could borrow money from other banks. This is how banks and investors make money. And it's how they protect themselves if someone does not repay that loan. We saw the result of this super low fee to borrow money reflected in mortgage rates at that time, which is why we're able to have 2% mortgage rates for almost 2 years. It cost the banks almost nothing to borrow that money and lend it to you. Fast forward to today, and the federal funds rate is 5.5. So until that rate goes well below 5, we aren't going to see mortgage rates below 5%. And it may be a year or two before that happens. So we can't control the Fed or the rates they set, but we can control how we respond and work with what we've been given. There is a reason savvy investors like Barbara Corcoran are saying now is the best time to buy, despite the 7 to 8% interest rates. Real estate is the best investment you can make for long-term success and wealth building. However, now is not a good time to buy for everyone. Real estate, just like the stock market, is cyclical. We'll have an up market for about 6 to 8 years, and then we'll have a down market for about 6 to 8 years, then up and down. Buying real estate right now is for the person who plans to own that home for the next 5 years. Now, let's talk about Washington specifically. The Seattle market is one of the least affordable housing markets in the United States. It's also one of the fastest moving markets, with homes selling in just 10 days. This lets us know that the high interest rates and high home prices are not stopping people from buying homes. The mortgage for an average home in Seattle would be around $6,000 a month, while the rent for that same type of home would be around $3,200. That is nearly double the cost. For many people, that does not make financial sense, especially in the short term. But let's say you do have some room to stretch your budget. Is it worth paying more to own a house than rent? Let's get into those numbers. Keep in mind, these are all estimates. Let's say you buy a home in Seattle at the average price of $966,427 with a 5% down payment of around $48,000. Working with a 7.87% interest rate on a 30-year loan plus taxes and insurance, your monthly mortgage payment would be about $6,600. Renting that same house would be around $3,900. At the end of the first year, the cost of home ownership in Seattle would be approximately $178,000, while the cost of renting would be about $4,700. The equity you could have at the end of that first year would be around $152,000. So not quite breaking even yet. Assuming home values go up 5% each year, at year 5, you would have gained $408,000 in equity and spent about $584,000. By year 5 of renting, assuming rent only goes up 3% each year, you would have spent about $251,000. So you're spending $250,000 to live somewhere, regardless of whether you rent or own. So that's a wash. So we have to look at the additional amount you're spending to own the house and compare that with the equity you gain. You spend an additional $330,000 to be a homeowner and have gained $408,000 in equity. That's a 20% return on investment, while renting gives you no return on investment. Now, I get it. Paying almost $7,000 a month when you're used to paying less than $4,000 can feel like a gut punch. But what if you could buy a home and keep relatively the same monthly payment? This is where towns like Sumner and Puyallup come into play. Less than an hour from Seattle, with a median home price of only $508,000, Sumner could be the perfect place for those looking for more affordable housing. Using the same loan terms we used in the Seattle example, purchasing a home in Sumner could give you a monthly payment of $4,100. At the end of the first year, the cost of home ownership in Sumner would be about $95,000, while the cost of renting would be $47,000. The equity you could have at the end of that first year would be around $87,000. Assuming home values go up 4% each year, at year 5, you would have gained $344,000 in equity and spent about $315,000. By year 5 of renting, assuming rent only goes up 3% each year, you would have spent about $250,000. Again, assuming you're spending $47,000 on rent each year, regardless, the $2,000 increase to $49,000 for a mortgage each year is not that much, especially since you gain so much from being a homeowner. Of course, there are ways to lower these costs and get a lower interest rate. This is good news for folks going through major life changes like a growing family, downsizing, or relocating to a new area that necessitates buying a home. Let's go over 3 ways to get a lower interest rate right now. Find a home with an assumable mortgage. An assumable mortgage allows a new buyer to take over the seller's loan terms, including the interest rate and the remaining balance. One of the advantages of this type of mortgage is securing a much lower interest rate than current market rates and potentially lower closing costs. However, not all loans are assumable, and the qualification process can take much longer. So this may not be a good option for those who need to move quickly on the buy or the sell side. Also, any difference between the home sale price and the mortgage balance may require additional funding. Number 2, a buy down. There are 2 types of buy downs that are really popular right now. One is a temporary buy down where the interest rate is reduced for the first few years of the loan and is typically paid for by the seller or the builder. This is a great way to get a lower monthly payment while we wait for interest rates to come back down. However, after the buy down period ends, the interest rate goes back to today's rate, so that's 7.87%, which means the payments increase, which could cause a financial strain if you aren't prepared for it. The other option is a permanent buy down that reduces the interest rate for the life of the loan. I don't like this one as much because it is more upfront money out of the pocket for the buyer, and if you aren't in the home long enough, you don't always get to recoup that cost. The last one is an adjustable rate mortgage, which is a mortgage with an interest rate that changes over time based on a financial index. One of the pros is that it often starts with a lower interest rate, just like the buy down. However, the rate and monthly payments can increase over time, which creates uncertainty and potentially higher costs in the long run. They can be a little bit more complex and are riskier if interest rates do rise significantly. It is impossible to time the market perfectly. The theory and concept around when to buy a house is the same now as it has always been. If it makes financial sense for you and your family to buy a home now, do it. If it doesn't, don't do it. There is no shame in renting or living with family or friends while you get your ducks in a row. I have these conversations every day with my clients as we put together their plans for buying a home now, 6 months from now, and even a year from now. If buying a home is something that you have been thinking about, but you're wondering if it's the right time, give me a call. I am happy to chat through it with you. We can't control the market, but we can control how we respond to it. Again, I am Rebekah Daniels, a local real estate broker in the South Sound, and until next time, make it a great day.